Are we already in a recession and could have been worse? Have you seen its signs? If you're not observant enough or need more knowledge of what is happening in the economy, you might think that there's nothing to be worried about. Most people might not be paying attention, but as we said in our previous topic, there is nothing wrong if we prepare for the worst, and that is the wisest thing to do, whether we're going through a recession or not. In today's video, we will give you a few signs of recession, a worst kind of recession, and we will hear from the observance of an expert, Cathie Wood. Who is Cathie Wood? American investor Cathie Wood is the founder, CEO, and CIO of the investment management company ARK Invest. In a video, she has imparted 4 signs that was coming as worse than a recession. She started with a message that says
that we are reaching a cathartic moment, and I do think it started.
Here are the 4 signs. Number 1. M2 growth peak. What is M2? M2 is the U.S. Federal Reserve's estimate of the entire amount of money in circulation, which includes all of the cash that individuals have on hand, as well as all of the funds put in checking and savings account, as well as other short-term savings accounts, like certificates of deposits or CDs. M2 is an important consideration when predicting inflation. The general economy is significantly impacted by inflation and current interest rates because of their significant effects on employment availability, consumer spending, company investment, currency strength, and trade balances. According to Cathie Wood, M2 has increased, and she said,
M2 growth peaked at 27% in 2020 and has been slowing ever since. We believe it is closing in or might be below 3% on a year-over-year basis, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up.
There are a lot of factors that justify that M2 is increasing. So what does it mean if M2 is increasing? When there's more cash out there, more cash gets spent. A little more can be good. A lot more can increase the risk of inflation. Number 2. The use of derivatives in pension funds. A pension fund is a fund where money is saved so that employees can get a pension when they retire at the end of their careers. Pension funds usually pull together large amounts of money to invest into stock and bond markets to make money or returns. A pension fund is an institution that invests large amounts of money in both public and private companies. Cathie explained further.
There is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match 1-for-1 the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view, but they don't. And with banks and a very low interest rate environment, they got used to using derivatives.
So to understand LDI better and its relationship with the pension, for a retired person to use the LDI strategy, they must first estimate how much money they will need each year. All possible income, like Social Security payments, is subtracted from the amount the retiree needs each year. So why use derivatives? Due to its flexibility in investment and enhanced certainty that a scheme will achieve its goals, derivatives can play a significant role in LDI strategies. It can also help to reduce risk and improve funding levels. However, with all the crisis we face, using derivatives is not a good idea because interest rates seem very low. And if this keeps going, pension funds will get margin calls, and if this keeps happening, banks will collapse, as per what Cathie Wood said.
What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case, for these derivatives.
As a result, pension funds will do deleveraging. So what happens in the leveraging is that you sell the most liquid asset, which is no other than government bonds, especially now that the market is in duress. Number 3. Used car index will collapse. Cathie Wood included the used car market on the list, and here's why.
Yesterday, we got the Manheim Used Car Index. It's a value index, pricing effectively. And it dropped another 3% plus. It was 4% plus decline last month. And so what we have now is the year-over-year increase has gone from 54% in April of 21 to minus 0.1. That index peaked in January and is now down 14% just since January. It's declining at more than a 20% rate.
Since there were fewer new cars and they cost more, used cars became more valuable during the pandemic because people wanted to avoid mass transit. But slowly, steadily, and as expected, the number of new cars being made is going back to where it was before the pandemic. That will change how much used cars are worth. So dealers who pay too much on used cars would sit on losses, and they will have to disgorge those inventories. Number 4. Retailers awash in inventory. One of Cathie Wood's examples here is a world-renowned shoe brand in which inventories have increased by 40%.
You know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well.
This also happens to a lot of retailers. So what happens when there are too many inventories? You usually end up with too much stock when you order or make more than you can sell. Most of the time, overstocking and understocking are signs of poor inventory management. But the problem might be caused by something else in your business. Awash inventory could result in financial constraints, cost of holding and storing missing sales, unsatisfied clients, product waste of degradation, obsolescence of products, and lower profits. After seeing all these signs, may we all become observant of the many possible signs that a recession or worse than a recession could happen anytime. These times everything is possible, and let's take these signs as warnings. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.